Okay, it's 2:30 on Thursday, the 29th of April. Hello and welcome to today's Crossing Borders broadcast. So a little bit of housekeeping before we kick off. As ever, we want to make this session interactive as possible. You can ask questions using the GoToWebinar widget, which is located on the right hand of your screen, and to keep you engaged as ever, we'll have some polls which will come up on your screens. So we're going to test the poll out for today. Let's see and launch that. So you should see that is coming up. Still some results coming through. Okay, I'm going to close that and let's publish the results of this, of the poll. So where are you watching us from today? I can see that overwhelmingly people are in Europe and Africa. Then there's in joint second place, the Americas and the Asia Pacific region. So that's fantastic. Let me close that off and open up. Also in the widget, you can find information about the presentation that will be delivered today and information about the IMC. We'll also have a short video, so stay with us until the end. Finally, I just want to thank Investaureum, who are kindly sponsoring today's broadcast. So today I'm joined by economist, scholar and author, Professor Andres Solimano from Chile. Professor Solimano holds a PhD in economics from MIT in Cambridge, Massachusetts. He's the founder and chairman of the International Center for Globalisation and Development and formerly a country director at the World Bank. His recent books include Global Capitalism at Disarray, Inequality, Debt, and Austerity, and the list goes on and on and on. Professor Solimano also published for the IMC working papers, a paper in 2018 on the global mobility of the wealthy and their assets, and that paper is available to download from the IMC website. So welcome to Crossing Borders, Andres.
Okay, thank you very much, Bruno. Very nice to be here, connected with the IMC here in a virtual way. We connected with the IMC streaming at this Cross Borders webinar. Very happy again to see you and connect with the rest of the audience.
And it's a good morning for you because I know it's quite early in Santiago.
Well, it's around 8:35 in the morning. I know that you are there 6 hours ahead, but it's fine.
It's the start of your day. So for our listeners, during today's broadcast, we are going to be focusing on how the incoming slowdown and the recession due to SARS-CoV-2 or COVID-19, the disease that is caused by this coronavirus, and of course the contention measures and how they compare with previous recessions in the world economy and how we can cope with this current slump. We'll also look at how will this affect investment migration, citizenship by investment programs, residency by investment programs. Will it be stopped? Will the industry come to a halt? Can it possibly recover? We talked a little bit earlier on, Andres and I, about the potential lack of availability of air travel, given the fact that the airlines are suffering like they've never suffered before, a crisis that is worse than 9/11 or the recession of 2008. And of course, there's the question of whether or not governments are prepared to open their borders and continue with visa-free arrangements that have been unprecedentedly not challenging but comfortable for travelers in the last few years, and never has the value of most passports increased so much, and with that the possibility to travel visa-free around the world. So I know, Andres, that you're quite keen to start. You've got a presentation for us, so I'm going to hand the floor over to you, Andres, and kick off your presentation, and I'll switch my my camera off at this point.
Okay, thank you, Bruno. Okay, good morning or good afternoon, depending where you are located in this webinar. Well, the purpose of my presentation is basically to put the COVID recession, so to speak, of 2020. I mean, we are still midway or halfway on this recession, but the projections of all international organizations, starting from the IMF, the International Monetary Fund, is that we will have a very rough year economically, not only on the health side, in 2020. So I want to put this impending global recession in historical perspective, comparing it with previous slumps. And then I will discuss some differences and similarities between what is expected to occur this year and perhaps next year, and what happened in these previous episodes. And then I will, as Bruno hinted, make some observations on the present and future of investment migration in the current juncture. And then I will close with some remarks on what are the main prospects ahead. Well, first, it's important to realize that what is creating most of the hardship in is not so much the spread of the COVID itself, but the containment policies. Containment policies, of course, are needed, and health should be put first in the priorities of all governments and authorities. But this is having a side effect. Perhaps we can go to the next slide, Bruno. To the yes, to see the anatomy of the shocks, and then I will discuss what the numbers look like. Well, first we have a very complicated combination of three types of shocks. One source is on the supply side, the lockdowns. I mean, these directives that people remain at home restrict mobility of people to go to the workplace. So they close shops, they close restaurants, they close the cinemas. The factories are working halfway or 1/3 of their capacity, etc. So the availability of workers have been sharply reduced because of the quarantines or the lockdown, and this amounts to a supply shock. There is simply less workers able to work with the capital stock they have available at work. So there is a decline in the productivity of capital and a disruption of supply chains. With the closing of borders, products are having the closing of borders more for the mobility of people, but to some extent also the mobility of goods. So this creates some disruption on the supply chain. That's one source of economic disruption. The other, it comes on the demand side. Firms are laying off workers, wages are reduced, and this is having an immediate impact on aggregate demand via consumption effects. People are cutting down their consumption to some extent. Then you have another important component of aggregate demand, also shattered by the shock, which is private investment. There is a lot of uncertainty, there is a fall in demand, so investors will say, let's wait and see. So you have an effect on investment. Then exports. the fact that this is more a global recession that spread out throughout Western Europe, Eastern Europe, the Americas, to less extent, but also exists in South America, in Africa, in Asia. It's a global. So export markets are shrinking. So we have the perfect storm: cutting consumption, cutting private investment, cutting exports. At the same time, there are some financial dimensions. Asset prices are declining. You can see the Standard & Poor, the Nasdaq, all the indices of the stock prices are going down, up and down. It is a very volatile market, but in general, the tendency is for a depression in asset prices. Financial wealth is reduced. Credit crunch maybe maybe a possibility, and then also a sudden stop of international capital flows. Then, next slide, please. Well, here is a chart. You have the PPT. You can study it. I think it basically shows the disruption of the circular flow associated with the sea crisis. I will not go in detail into this table because we have relatively short time allotted to the presentation. I want to leave space for Q&As. Okay, let's go to the next slide. Well, the question is, and this is the purpose of this presentation, really, what the history of recession tell us? Well, this is a long history. I just published a book with Cambridge University Press called A History of Big Recession in the Long 20th Century, basically from 1914 to 2015, around 100 years of recessions, that tell the story in more detail, 300 pages devoted to this topic. But here I would like to highlight some of these episodes and make comparisons with the current COVID slump. Well, first, we may distinguish between global recessions in the last, let's say, 90 years and regional crises, and then, of course, national crises. The three main global recessions of the last 90 years are the Great Depression of the 1930s, the stagflation of the 70s. You remember, those that are older, that we had oil price shocks, we had the abandonment of the Bretton Woods system, we have geopolitical tensions in the world, the Vietnam War, the Iran crisis affecting the US, a lot of labor unrest in Europe, etc. Revolutions in the Third World. It was a complicated decade, the 1970s, both politically and economically. And then we have the global financial crisis of 2008 and 9. This is more recent, falls in the 10-year cycle of some big slumps that we are observing in the last 30 years or so. I will start with some comparison. Then we have regional crisis, the Latin American debt crisis of the 80s, the East Asian crisis of the 1990s, the post-socialist slump in the 1990s in Central and Eastern Europe. Next slide, please. And also we have other main disruptions, which are not exactly recessions, though they provoked declines in economic activity, but there were what I would say big catastrophes, some man-made, other more made by natural factors, biology, etc. World War I, World War II, the Spanish flu of 1918 and 1919, other pandemics, climate destabilization. This is not part of, well, now it's part of history or recent history, but it's a potential catastrophe that we have to consider. Well, of course, the nuclear threat is always there, terrorists, etc. So we are in this COVID context within the realm of big recessions and catastrophes. So we have to consider that. Well, just some highlights on some of the slumps. The Great Depression, you know, it was preceded by stock market crash of 1929. It was amplified by the straitjacket provided by the gold standard. There was no possibility of depreciate in nominal terms the currency in the country that were stick to the gold standards. Central banks could not undertake monetary expansion, the fiscal restraint was in the cards, was always there. So government were with their hands tied to jumpstart again the economy, and that's the difference with the situation now. We are no longer in the gold standard. We have a system of flexible exchange rates. Governments can use the monetary mechanism, monetary easing, etc., that was not available in the 1930s. Also, issues of international policy coordination. You have to remember that there was a period of declining British hegemony after World War I that started early in the century, but America was not willing to become the new global hegemon. It became after World War II, but not in the 30s. That affected a lot of policy coordination. That's an important lesson for the current juncture. Are we in a good political mood or geopolitical situation that will help coordination among main nations to deal with this crisis? I'm not sure. We have, I mean, the US more in a turn to isolation strains, Europe with its own problem, etc. It's an issue I leave it open. Next slide, please. Well, the stagflation of the 70s I already mentioned was related to the Bretton Woods parities, the oil price shock of 1973-79, inflation and currency instability, and volatile social conditions. Then, if we think about the next slide, well, the global financial crisis is the most recent one. It was originated, you know, in the real estate market in the US, the subprime loan problem, then it spilled over to the financial system, and then propagated internationally to Europe and the rest of the world to some extent. Developing countries didn't suffer that much, but still they had some effects of this. Again, this is a crisis like in the 1930s that had a financial component, very important. Now, the crisis originated more in a health shock, a virus, the spread out of COVID-19, etc. So this is a very important difference between one or the other. Still, we have to watch the effect on financial markets of this crisis. Another issue, and perhaps is that, okay, here there is a nice slide that compares, if you can see, the effect of the global financial crisis on the right-hand side of the slide, of 2009, the fall in GDP in the US, Euro, and Japan. But the fact is that China and India, two important economies in the global scale, kept growing at rates between 7 and 9%. That's very different if you move to the left of the chart, when you see the purple bar and the green bar, which shows economic growth in China and India very much diminished. 1% in China, 2% in India. These are the projections for 2020. So we have, and this is a very important lesson, that before we approach to the end, is that the global economy is working with the engines are failing. It's like a plane with two engines, and the two engines are failing to some extent. One engine is provided by the US economy, which the IMF is expecting to contract by 6%, a 6% decline in GDP, the largest recession since 1930. And then we have not a recession, but a sharp slowdown in growth from around 6.5% to 1% in China. So the plane has problem to fly because the two engines are not working in full steam. That's a very important difference between now and 2008 and 9. Let's go to the other slide, please. Well, here I put some 4 charts, or one chart with 4 panels, that show this typical cycle that occur with under pandemics. The 2013 SARS, 1957, 58, H2 and 2, 1968, H3 and 2, and the 1918 Spanish flu. Well, the main lesson of these experiences is that there was a V-shape cycle, a sharp drop in economic activity once the flu set in, and then a rapid recovery. This is called the V-shape. Okay, like a V is a diagram of the behavior of economic activity in each episode. The question, of course, is: will we have a V-shape after the COVID recession? The IMF is projecting that next year we'll have a strong rebound in economic growth almost everywhere in the global economy. It remains to be seen. It may happen, it may not happen. Okay, so that's an important piece of information we have to keep in mind. Okay, perhaps we can go down to the other slide. Well, the other slide is Bruno. Well, I just
yes, totally. Just having a small technical issue here.
Yeah. We'll okay.
In a second.
Yeah. Well, perhaps I can skip the slide. Is basically it's I show great. Thank you, Bruno. Here I put this economic sectors of economic activity according to national accounts, dividing them in three categories: sectors with high exposure to the COVID crisis, sectors that are more resilient, and sectors that have an upside potential. If you take a more detailed look at the PPT afterwards, you will see that, for example, tourism, lodging, leisure activities, retail trade, of course, passenger airlines, global shipping are the sectors more exposed by the crisis. And sectors that have an upside potential, because in any crisis there is an opportunity too. We don't have to be too pessimistic that everything is bad. There are some things that could be for the good. And for example, home delivery activities. People remain at home and they need they call the grocery store. Please, can you bring me oil, rice, bread, etc. Well, these activities are not being affected that much. Well, the clinical and medical services, of course, because of the situation, they may have a boost here. And also very important, but this is more for advanced economies, or economies that have technological capacities, internet and communication platforms, technology sectors are going to be probably benefited by this. And we are using GoToWebinar, we are using Zoom, etc. in these times to connect us. So this will be a positive effect. E-commerce. Okay, let's go to, before closing, to what may happen to investment migration, a very important concern for all of us here. Well, first, the COVID crisis is pushing towards deglobalization, but the tendency for deglobalization, for cutting ties among different economies, came already into place before this flu. Brexit is one example. Trade wars between the US and China, problems in international trade between the US and Mexico, etc. So now with the actual closing of borders, the sharp slowdown in air traffic, mobility restraints, I think this tendency will affect the globalization. This may affect the attitudes of the public and therefore the responses of governments toward investment migration. Still not clear, but will, I mean, in an environment in which the rules of the game are changing, perhaps the attitudes toward the admission of investors and the granting of permanent resident cards, citizenship rights, etc., may be affected by the current juncture. I leave it open. I'm not saying it will be a closing or crashing of the industry. We have to be alert on which the direction will go, but still, this is not a very favorable environment, perhaps, for the international mobility of people in general, and particularly for international mobility of investors. And also, investment migration is a kind of diversification strategy. I mean, you want to reduce the risk that you may face for your wealth. You want to bring your children to places that offer better education, better other amenities, safer cities, etc. When the whole world more or less caught in a recession, closing borders, etc., this diversification is very difficult, because you can diversify when the fortunes of countries are not correlated among themselves or are uncorrelated. But when they are closely correlated, it's more difficult. The other factor that I would highlight here is that you have to consider that the fall in asset prices that is coming with this crisis reduce the financial wealth, and less resources on the demand side will be available to invest in, let's say, by meeting the requirements posed by governments to grant CBI and RBI categories. So this wealth effect you have to consider. Well, again, this issue of political legitimacy of second and third passports in a context of the contracting global economies is open. But at the end of the day, we have to also consider that countries, crisis country particular, need foreign capital, need investors, need transfer of know-how, etc., to recover. And that was one of the reasons why this industry started to pick up after the last big crisis, 2018 and 19. So this keeps us optimism for that there will be a recovery of the industry. Okay, let me close with the last slide very briefly, because we need time for discussion. Prospects ahead. I mean, the IMF, again, which is probably the most heard source of projections in the global economy, the Bretton Woods institution, the World Bank Group, etc., the OECD, etc., all are projecting that we are going to face a bad year, rough year 2020. The projection of the IMF is a global contraction of -3%, hitting more hard the center economy of the capitalist system, the US, Western Europe, Japan, Australia, and less developing countries, emerging economies in Latin America and in Africa or Asia. But still, the prospect is for a big contraction. The question again is, will we experience a V recovery? The IMF thinks it's 2021 we're going to be growing again, but maybe a U recover, a slow recovery of economic activity, or even a scenario of stagnation, an L-shape cycle. Okay, L-shape it was observed in the 1990s, early 2000 in Japan. It was observed in Greece because of austerity problems. It was observed in Latin America, and to an extent it was also observed in Europe after the 2008-2009 recession. Everything will depend also on the dynamic of the contagion, the duration of the lockdowns, and the policy reaction on national and international levels. The response, again, I want to underscore the importance of international policy coordination to get out of this situation. International policy coordination was very difficult. We already discussed that in the 30s. It may be more complicated now than in 2008 and 2009. Okay, the politics is different. We have the rise of nationalism, deglobalization, etc. So watch out that. At national level, countries, many things will depend on the attitude of government and the capacities and the institutional strengths or weaknesses to face this situation. Countries with weaker institutions will suffer more than countries with stronger institutions. And for investment migration, watch out, and then we can discuss more on this. Okay, this is it, Bruno. Thank you very much for the kind help with the PPTs.
Okay, I'm here. It's
okay.
absolutely Thank you so much, Andres. Look, we've had a few questions coming in on your presentation, and one of them, and maybe I'll start sort of back to front. This is a question focused on the investment migration industry. A gentleman from Switzerland asked, can you just run through what exactly you mean by the political legitimacy of second and third passports, which was on one of your slides, I think, and I'm going to try and get that back up. Yeah, here it is.
Yeah.
It was this part here. So can you just give us a bit more detail on that? Exactly what you mean, please, Andre?
Okay, should we go? Should I reply to each question here now? Okay.
Yeah,
all right. Well, yeah, I think. I mean, the problem is political legitimacy. I mean, of course, this is more a political science term than an economic term, but still, I think it's a useful terminology. No, the point is that in an environment in which there are more skepticism on the benefits of globalization, because people say, well, okay, globalization is good for economic reasons, for other reasons as well, but at the same time, globalization, you globalize a health pandemic. Okay, the thing is that quickly in 1 or 2 months, something that started in one country, let's say one region, let's say in China, spread out around the world like fire. So they say, is it good globalization at the end? Would it be better to start producing more for the internal market to secure the sources of inputs, the sources of goods? Will it be better to restrict somewhat the mobility of people, not so much migration? I'm a firm believer in free international migration of all sorts, so I don't share those concerns, but I still try to understand their logic. So that may affect the industry in the sense that people question, well, to what extent people that have economic resources can get access to second or third passport or residence permits vis-a-vis the poor or the simple workers that go to other countries have to wait, let's say, for 10 years for a green card or a residence permit, etc. So in an environment where you have more nationalist tendencies emerging, where you have skepticism or at least a critical appraisal of globalization, the way it has been practiced so far, I would watch that. In that sense, that's the sense of the statement.
Yeah, it's fair to say that there is an element of this sort of patriotic or nationalism that's coming through from politicians. If I look at the EU, which is a project just was formed after the Second World War in terms of bringing nations together, initially France and Germany, to avoid another war. So it's about cooperation. We have the fundamental pillars of the European Union, and one of those is the free movement of people. Then you have free movement of goods and services. But since the COVID-19, we've seen a lot of EU governments that have not heeded to the pleas, first of the World Health Organizations, that initially said, actually, you don't need to close your borders, and secondly, the EU not saying anything at all. So what you have in EU countries saying, well, I'm going to close my borders anyway. So, how does that potentially jeopardize the value of investment migration if in cases like this all of a sudden you can have borders being shut almost overnight?
Yes, no, for sure. I mean, you have a tension between decisions made at national level and the recommendations of international institutions and regional integration bodies like the EU. etc. Which one will prevail? Probably it will prevail more the decisions made at national level. But we have to put a time dimension on this. This is, this is a phenomenon that, the worst of the crisis is, still the crisis is very serious, of course, but in terms of the rates of contagions are stabilizing or declining in some countries that have been hit hard, in Spain, in Italy, in France, etc. The US is more complicated so far, but this is a phenomenon that will be, let's say half a year or so, the worst part, but probably 2-3 months of the starting of the contagion. Now we're thinking that the governments are starting to be able to curb it, etc. So it's very difficult to make exact predictions for the medium run, because we are in the middle of the crisis. On the other hand, this is an industry still in relative terms, a relatively small industry. If you compare the around 60 to 70 billion euros have been mobilized internationally since in the last 10 years by investment migration, using the investment migration insider monitor numbers. And if you compare to total global capital mobility, this is very small, very small. The numbers also of people is not mass migration. And also it's a contribution to investment in the real estate, well, in business, in the Caribbean countries have been able to rebuild their infrastructure hit by hurricanes, natural resources. So the government may weigh the benefits of this industry, but my warning is that this is part of a more general environment that we have to consider, and there are trends toward reducing international mobility of people. But it's difficult to make an exact prediction in which direction the whole thing will go.
Moving on, Professor Solimano, in your opinion, which countries are coping the best, or which countries' coping model is working the best?
Well, here I would distinguish coping the best or the better in economic terms and in health. Huh?
In economic terms.
In economic terms and in health. Well, they're of course correlated, but I don't know. Here, I attended a webinar last week organized by the Royal Economic Society and the International Economic Association on the effects of COVID-19 for developing countries, and Latin America, Africa, Asia, etc. And the effects are, well, there are several African economies that are growing, are expected to grow this year. And this is including the IMF. India growing 2% is not bad for the current situation like this. China 1% is hit hard. So in Latin America, those projections are for decline between 2 and 4%. This is less than for advanced economies. It's difficult to say in advanced economies which economies doing well or doing better than others. I think the US will be hit very hard, okay, because it's the country with the peak number of contagions, the big number of fatalities. It is in an election year. There are a lot of tension between the presidents and governors. It's a very complicated situation in the political economy of managing this crisis. So, and this is a very important economy in global terms. So, but countries are committing important resources to combat the effect of the recession, 5, 7, 8% of GDP. Countries like Sweden are taking a more a different approach to the emergency. They don't have a compulsory lockdown, but they advise people try to stay at home, but they have kept restaurants, cafes, etc., commerce open. And so that, I think, will shield the economy from the worst of this COVID crisis. So other Scandinavian countries are managing. I mean, Denmark and Finland are not exactly following the Swedish path, but it's different also from the pattern of Western Europe and the US and Canada. So there is a lot of diversity. It's very difficult yet to say.
For the rest of the world, I think what everybody wants to know, I guess, and I'm not saying you've got the answers, but how fast of a recovery can we expect after the worst of this pandemic is over? So assuming we have probably until the end of summer on sort of semi-quasi lockdown and restrictions, how fast can the world get back to some sort of normality in respect of its GDP growth?
Yes, that's an important question. I would say, for example, the OECD and the BIS, the Bank of International Settlements, have calculated that per 1 month of lockdown, you should expect a decline between 2 and 2.5% of GDP of the country. So 2 months of lockdown, minus 4% of decline, negative growth of GDP. 3 months of lockdown, 6% of GDP. I don't think there will be more than 3 months of lockdown. It's very difficult to maintain lockdowns for quite a while. So I think that in the second semester of this year, 2020, we should be seeing a certain recovery of economic activity. Still, I think the year as a whole will close with negative numbers. But the hope is that this will continue in 2021. Sorry.
Right.
That's one thing. But the historical record of recessions and the post-recession dynamics calls for caution. I discuss it in the book, showing that there are many cases that you may have, you may observe a stop in the fall of employment, of output, of investment after a big shock, after a recession or depression. But then a pickup of economic activity may take longer. In the 30s, the recovery really was established since the start of World War II. In the 30s was ups and downs in the US, in France, in the UK, in Italy, etc. So half a decade could be lost. In terms of recovering the level of GDP that was before the crisis. So Japan, again, Greece, and here I connect with the point that you were making, Bruno, in the European Union. I think it's very important. I see a differentiation between the austerity country, Austria, Finland, Germany, Netherlands, and the countries of the southern periphery, Italy, Spain, Portugal, Greece, etc., maybe the Baltics too. They require more resources, debt forgiveness or something like that. They are asking, even France, President Macron is asking for a collateralized debt, issuing of debt that are supported by different governments, whether you are in better shape or worse shape. That incidentally was the proposal of John Maynard Keynes to avoid the big contraction of Germany and the Treaty of Versailles. Keynes also in 1922 in the Genoa Convention, and then in the different plans to help recover Europe, he also was leaning in favor, very openly, very explicitly, of issuing debt that was collateralized by all countries in Europe. And the same proposal is being made again by President Macron of France, but he's facing skepticism or even resistance from this the austerity countries that I just mentioned. So a lot will depend on that, on how much money governments want to put and how much debt will be tolerated to be issued.
And it becomes also very political, doesn't it? As we head into election territories, there's quite a few countries around the world that are meant to be having elections this year and next, of course. Moving on, we've got a couple of comments. So I'll just go through some of these, Andres. So thank you for a very good summary of things ahead. That's from Sam Bayat in Canada. Could I get a copy of this excellent presentation? That is from Sashit Kumar. Sashit, if you are on the GoToWebinar platform, in the bottom right of the widget, you should see a box with different handouts. And there, if you click on the presentation, it will open on your screen for you. So we've got a question from Andres Gutierrez, who's an Argentinian neighbor of yours, Andres,
okay.
now living in Europe. And he wants to know what your views are towards the introduction of a wealth tax or citizenship-based taxation to overcome the recession versus the ability of high net worth individuals to legally plan their residence and then being able to contribute to foundations. So I guess the question is, should governments start again thinking about wealth tax, taxing the rich, or having some of the taxes or donations from high net worth individuals that are moving countries and benefiting from investment migration, diverting some of that money towards the recovery efforts. What are your thoughts on that? It's very complex. It's very populist, isn't it, to tax the rich? Politicians, often do like to use that kind of terminology, don't they?
Yeah. Well, yes. Well, here I would say the following. One of the problems of globalization, of the type of globalization we have experienced in the last 30 to 40 years, has been the sharp rise in economic inequality, income inequality, wealth inequality. So, and I think to make globalization more viable, more stable, more sustainable over time, particularly given the shocks that we are experiencing now, the COVID-19 shock, particularly at the concomitant economic crisis, I think we need a type of globalization that deals with inequality. And we can, one proposal, and this has been in the cards of people on the academic side by Thomas Piketty, Gabriel Zuckman, other people. In the US, it was the wealth tax was favored by Elizabeth Warren and Bernie Sanders, not quite by so explicitly by Joe Biden. Has been proposed in some ways by the Labour Party in the US, in the UK, sorry, Corbyn, etc. So it's in the cards. It's in the cards. There are some merits. There are some complications also with the wealth tax. Well, there are countries. I mean, there is a nice publication by the OECD that there is a paper that analyzes the wealth taxes. Well, you have wealth taxes in Switzerland, and you have in a few countries wealth taxes. There was in Italy. Other countries have moved away from wealth taxes. I'm not against it. I think it's something that can be considered, particularly because we need a more fair sharing of the benefits of globalization when there was a boom in the global economy, and also we need a more fair sharing of the cost of crisis, of the sort of crisis that we are experiencing now. I think economic elites need to bear a share of this.
Territory, isn't it? I mean, it's quite dangerous territory for governments to head down that route. I remember.
Yeah, it should be a moderate tax. It should be a moderate tax. It's not
so long ago when François Hollande, the French president, introduced, wealth taxes. What you suddenly had is an exodus of high net worth individuals driving their cars into Switzerland, into Luxembourg, into Monaco, into Liechtenstein, and they, literally on the doorsteps, and they're no longer paying taxes into, the French treasury. So it's very contentious, this issue, isn't it? It's populist, but at the same time, it can have its negative repercussions. Okay, look, we're running out of time here. But I know you've got a new book coming out, The History of Big Recessions in the Long 20th Century. What is that about, please, Andres?
Yeah, the book was published in February, and because of the lockdowns, I haven't even received my own copy from from the press, because the postal office it is being sent from New York and from Cambridge in the UK, and it's somewhere stuck there. But the book basically is a detailed analysis. With there is a chapter on World War I, World War II, and hyperinflation in the 20s. There is a chapter on the Big Depression. There is a chapter on the stagflation of the 70s. There is a chapter on the history of socialism and the rise and death of the Soviet type of socialism in the 20th century, and the recessions and the problems that they face after socialism and during, in some cases, and in the end ends up with the global financial crisis of 2008 and 9. So everything you want to know more or less is there about the recessions and calamities of the world. There is no chapter yet because it was published before the COVID-19. But it can be helpful.
Andres, if any of our viewers are interested in reading the book, where can they get a copy from? Is it available on Amazon or Book Depository?
Yeah. Yes, there is a very affordable copy edition by Kindle and paperback through Amazon, but also you can go to this other book depository, and also just write directly to Cambridge University Press, and they should be able to send you a copy of the book. So the book is you can read in Kindle, paperback, and if you you want to have a hard copy, you have to. It's more expensive, but the others that are more affordable. But Amazon Book Depository, Cambridge University Press, all should be able to supply you very quickly a copy of the book. Can be, I don't want to give publicity, but can be helpful to put this crisis in perspective.
So, of course, Andres sits on the governing board of the Investment Migration Council. And as most of our viewers would know by now, we had to postpone our annual conference, which was due to be held in June in Brussels, where you would have had the opportunity to meet with Andres and obtain a copy for yourselves there. So that will have to be put on hold a little bit. I'm afraid we have run out of time for today. I want to thank Professor Solimano very, very much for taking the time for joining us from Santiago on this session. I hope you, the audience at home, enjoyed and found this session as interesting as I did. I'd like to remind you, if you are not already a member, then please open the IMC handout in the panel on the right of your screen, and you can find information about joining the IMC. Don't forget to follow us on Twitter, on LinkedIn, and you can view all of the Crossing Borders broadcasts on our YouTube channel. We will be back next Wednesday at 2:30 Central European Time, where I'll be joined by 3 due diligence professionals in London and New York, and we'll be talking and dissecting due diligence in investment migration. 3 big professionals, well known in their field, that have been heavily involved in drawing 2 reports on due diligence that were published earlier on by the Investment Migration Council. So stay tuned for updates. Until we see you again next Wednesday, please stay safe. Thank you for joining us. Once again, thank you very much, Andres. And we will leave you with a short video about the Investment Migration Council's certification in investment migration, which is a totally online learning environment. Thank you very much.
Thank you very much, Bruno. Wonderful session for me also. Thank you for the questions and the remarks. It's an open subject. We will have other opportunities to keep talking about and exchanging on these issues. Thank you. All best.
Bye-bye.
Bye.
Introducing the Certification in Investment Migration from the Investment Migration Council, the first structured learning product of its kind globally, designed for you. Explore the bite-sized learning pathway of each module on our custom online platform. You can track your progress as you go and learn at a pace that suits you, with an estimated 5 hours of study time per module. The Certification in Investment Migration contributes to the development of professional competencies and standards for those new to or already working in the industry. So, what are you waiting for? Visit our website to start your learning journey today.